Let's keep the conversation going here regarding the end of the Great Moderation and what it means for investors with Luca Paolini. He's chief strategist at Pictet Asset Management. Luca, it's great to see you. So do you agree?
Good morning.
Do you agree that we're at the end of this period? And what do you do about it, I guess, if we are at that point from an investing standpoint?
But look, it's a difficult question, of course. I think it's fair to say, though, that what we are seeing during COVID has been a tremendous increase in volatility. And I do believe that what we are seeing now in terms of GDP and inflation is something that you have to put this into context. And I think we have probably to wait until the dust settles on this. But my concern is that inflation will be probably a little bit more volatile, but I don't see any upward trend in growth. So the risk here, you're going to get a little bit more inflation, maybe more volatility on inflation. I just don't see the increase in productivity that is required to generate more growth, which obviously for an investor is very tricky because you have more inflation and growth is the same. Risk premium will go higher and not lower.
Luca, if you can, take us further into your thesis about U.S. growth being underpriced right now.
Well, no, my point is that when you look at a lot of data, especially in general, has been very strong, pretty much across the board, not only in the U.S., but elsewhere. It's a combination, I think, of seasonal adjustment, the weather being better, and of course, a big decline in energy prices. But I think when you look at a lead indicator, we have seen the ISM yesterday, we're still at recessionary levels. Confidence is still quite low. It has improved consumer confidence, but it's still relatively low. So the yield curve is inverted. There are all elements that would suggest to me that growth will remain much weaker than investors expect. And that obviously means for equities that earnings will be weaker. So I do believe that this slowdown in the U.S. economy is not over, and investors are probably a little bit too complacent on that front.
And so if they are too complacent, what are some of the risks that we're going to see in this market?
I think the risk is that we're going to see more earnings disappointment on one side. I'm not overly concerned in the Fed will go to 6%, for example. I'm much more worried about the fact that the lags of policy tightening, monetary policy tightening, will be felt later on in the year. So I still believe that the risk that is underpriced is on growth more than inflation. We all know the risk on inflation, but I do believe that the risk here is on earnings. And valuation, by the way, is, especially in the US, is above average if you look at the 12 months forward PE. So you have growth being weak, inflation high, and valuation being, I think, if anything, a little bit too optimistic.
So within that set of parameters, what stocks do you prefer right now?
Well, let me say, first of all, that what we like is more bonds, short duration, high quality bonds, especially in the US. I think there is some good value in there. When you look at stocks, I think the story is simple for us. There is only one country that this year is going to accelerate in terms of growth, and it's China. China is cutting rates. Inflation is not an issue. Earnings will probably grow by more than 10%. We are all obviously aware of the risk of investing in China. But at the same time, from a tactical point of view, I think China has all the ingredients that you want for the markets to outperform. So we don't like the US equity market. We like emerging markets. And we are also cautious about the rally we're seeing in Europe. And so that's why we tend to focus pretty much on emerging market equities right now.
That makes sense then, given that outlook. When we look at central banks around the world, do you expect to still see this sort of coordinated tightening? And how long is that going to last?
Well, we expect 25 basis points in the next two meetings of the Federal Reserves. DCB has to do more. It's fair to say that. Japan is a completely different story. I think, though, that the peak of monetary tightening is pretty much now. I think that we're not expecting any rate cuts this year. But I think in a couple of months' time, I think the music would be, different when core inflation will be lower, where growth probably still fail to recover significantly. So I still believe that the next big move in interest rate will be down and not up. But again, we still have a few months probably to digest what has already been announced and the tightening that we have seen already.
Gotcha. Luca, good to see you. Luca Paolini is chief strategist at Pictet Asset Management. Appreciate it.